Hello, good afternoon, everyone. With this, I just start. Before begin, I would just like to thank Jinal ma'am, Secretary WIRC, Virag Shah, and Hansa for your kind introduction. Thank you very much. The non-corporate entities or non-company entities, rather I would say it is not a bit of unregulated, but a bit of unorganized this aspect where we need to just educate or we need to just inform the sector or the clients where you need to adhere to certain provisions. So once they come to know the consequences of non-adherence, they would insist us to just comply with this aspect. So that is the basic idea, rather than just much focusing on the non-compliance part. So with this, I'll just start my presentation. Also, I've just kept my presentation a bit precise, where I've just just ponder upon certain aspects of accounting standards, the basic points, and then the non-compliance part. But before that, the non-corporate entities, we need to understand what accounting standards are applicable to which kind of non-corporate entities. There are different levels also where the institute has revised those criteria, and FRRB board of ICA, that is Financial Reporting Review Board, have prescribed those level of criteria. So that is what I have also mentioned. So first we understand that these are the entities to whom accounting standards are applicable, and then we come to non-compliance, rather than just straight away going on the non-compliance part. So we also come to know that what accounting standards are applicable to which kind of entities. So friends, as I said, the agenda of the meeting is that understanding the objective of accounting standards which are applicable to non-corporate entities, then coming to then coming to applicability of accounting standards to different level of non-corporate entities, the basic relearn, or you may say a recap of the accounting standards. We know that we are aware about those accounting standards, but at times we just relook, or we forget to apply those particular aspects in our day-to-day routine practice. Or as we know that the deadlines has been extended, so it is the best time to just have a relook to those aspects, keep ourselves workings and everything ready, and complete our task in a more effective way. And fourthly, the non-compliance part with at large, which is applicable across the board. And yes, the most important, certain pointers and action points which I have just highlighted to avoid those non-compliance, which we can do in the whatever time span we have, since the deadlines has been extended. So as we all know that the non-corporate entities are the the common structure of non-corporate entities are basically the sole proprietor, the partnership firms, HUF, trust. Even if the trust is registered under the Mumbai Maharashtra Public Trust or Indian Trust Act, those are also regarded as a non-corporate entities. And the society can also be registered under Societies Act. So these all forms of constitution are regarded as non-corporate entities. Of course, if an individual, say Mr. A himself, and he being a partner in a partnership firm, this both of them will be regarded as a non-corporate entity. So friends, in June 2022, the ASB, the FRRB, came out with the change in the format of the financial statements which is applicable to non-corporate entities. So basically we need to understand, friends, that the change which has been brought, it is basically to standardize the preference, also which improves the effectiveness of giving out the information to the users of the financial statement, because the financial statements, friends, are getting circulated with various authorities, whether tax authorities, whether audit authorities, etc. So just to bring upon the standardization in line with schedule 3, the change has been brought in by the FRRB board, the ASB as well, of the ICAI. So as I said, we first look upon the entities to whom this accounting standards are applicable. So first we divide non-corporate entities into 4 parts. That is level 1, level 2, 3 and 4. Level 1 entities are basically the large entities, and level 4, 3 and 2. There is a reason where I have mentioned 4, 3 and 2 and not 2, 3 and 4. Because it goes like micro, small and medium. So micro entities are categorized as level 4 entities, small entities are categorized as level 3 entities, and medium categories are the entities which are covered under level 2. So a broad chart, just keep in mind this aspect, that accounting standards for non-corporate entities, we divide that basically into 2 parts, that is large entities, the MSME entities. Large entities getting out under level 1, level 2 is medium, level 3 is small, and level 4 is micro. These level 4, 3 and 2 are together regarded as MSME. So coming to what are level 1 entities first. Entities whose securities are listed or are in the process of listing on any stock exchange, whether in India or outside India. Now I'll just come upon this point shortly, because an entity which is listed can never be a non-corporate entity, right? But still there are entities which are listed and are regarded as non-corporate entities. I've just highlighted certain aspects with regards to that in the following slide. Second is banks, including the cooperative banks, financial institutions or entities which carry on business of insurance. This third and the fourth point is important. All entities engaged in commercial, industrial or business activities whose turnover excluding the other income. Please note it is excludes other income. Only those aspects, only revenue from operation is to be considered for the purpose of turnover, exceeds INR 250 crores immediately in preceding financial year. Fourth, all entities engaged in commercial, industrial or business activities having borrowings including public deposits more than INR 50 crores at any point of time. So if it exceeds this limit of 50 crores and at the year end, say at the balance sheet date, it is below the threshold limit, still since it exceeds the threshold of 50 crores, it will get covered under level 1 entity. So it is 50 crores at any point on time. And the fifth aspect, just a second. Sorry. The fifth aspect, the holding or subsidiary entity of any of the above category. So as I mentioned, friends, these are the non-corporate entities which are listed on a stock exchange. Not necessary listing means the equity listed. It can also be a debt listed. So basically the REITs, InvITs, ETFs, gold ETF bonds, these are the entities which are listed and regarded as a non-corporate entity. Because we have a tendency that if anything is getting listed, then how can it be a non-corporate entity? So that was the whole idea. So Embassy Office Parks, which is an RIT which is listed on BSE NSE, is also covered under level 1 entity, the Mindspace Business Park, Brookfield India REIT, Power Grid Infrastructure. So if you just search upon the entities in BSE, you can just find these aspects. Data Infrastructure Trust. Of course, one of the aspect, if you see that it mentioned that any entity for which the stock exchange is listed in India or outside India. Now, what are those entities which are listed outside India and regarded as a non-corporate entity? So we have Goldman Sachs, which is listed in New York Stock Exchange, which is also operating in India and has been regarded as a non-corporate entity in India. So this was one of the ETFs which I can just search upon, which are listed outside India. Coming to level 2 entities, all entities engaged in commercial, industrial or business activities whose turnover, again excluding the other income, exceeds INR 50 crores but is within the limit of 250 crores in immediate preceding accounting year. The second option is all entities engaged in commercial, industrial or business activities having borrowings more than 10 crores but within the limit of 50 crores at any point of time during the previous accounting year, and of course the holding or subsidiary entity of any of the above. Level 3 entities, all entities engaged in commercial, industrial or business activities whose turnover excluding the other income exceeds 10 crores but is within the limit of 50 crores and the borrowings is about 2 crores but within 10 crores. So friends, we don't need to get confused with regards to MSME, which is prescribed under the MSME Act. That is different and this is different. So this is prescribed by the ICAI for applicability of accounting standards. Of course, it has to be more or less in line, but sooner or later maybe we can see an amendment in this aspect also, because MSME Act has underwent a change where there is an increase in threshold limits. And level 4 entities, of course, which are not getting covered in level 1, level 2, level 3, are getting covered under level 4 entities. So just a summary chart where you can see large entities having turnover more than 250 crores and borrowings more than 50 crores at any point in time in preceding financial year, preceding accounting year maybe. Medium entities having turnover from 50 to 250 crores, borrowings from 10 to 50 crores, and the small entities are 10 to 50 crores turnover and borrowings from 2 to 20 crores. Now friends, let me give you a practical scenario. A partnership firm is a non-corporate entity. The entity has taken a loan from partners. It has a loan from financial institutions and bank as well. If we consider partners loan, the borrowing threshold crosses the limit of 50 crores. If we don't consider partners loan, the borrowing threshold limit does not cross 50 crores. So whether to include partners loan as a borrowing or we just consider outside borrowings. Outside borrowings meaning the banks and only the financial institutions. Any thoughts on this aspect? Sorry, sir? Yes. It is? Yes, that is what I said. That yes. So exactly as sir mentioned, that for the purpose of calculating the limit, borrowings is a borrowing, whether from outsider or whether within the firm. So partners loan is to be considered as for the purpose of 50 crores threshold limit. Yeah. F&O? Yes. Yes. F. So F&O, there is a methodology to calculate the turnover, correct, which is in which has been prescribed by the CBDT. So once you cross the threshold, it is turnover. See, if that is your business activity, it is by default getting covered under business and profession. So once it crosses the threshold, by default F&O turnover is also getting covered under this aspect. So you need to accordingly follow the accounting standards. So, sir, in that case, we also need to see additional two things. One is the interest, if we give interest with the partnership firm gives to the partner. And second, if there is any loan document has been entered into between the partnership firm and the partner. I understand for non-corporate entities, we tend not to enter into a loan document since it is the closely held entity. So if it has been routed through current account, you need to bifurcate it because you also tend to give interest on loan to the partners. So for calculating interest, you need to know what is the loan amount. So if that is done, then it is to be included for the purpose of the limit of 50, 10 or to whatever it is. Yes. No, so it has to be a so borrowing, meaning that the it gives a picture where you need the entity needs to repay it back. Current account transactions are account transactions usually where the routing of transaction is to and fro between the firm and the partner. So again, the interest cap is etc. is there. But again, what I would suggest is that if there is a loan aspect where you know that this is a loan, better to have a sort of MOU or a loan document placed in record. Because sir, now even we know that TDS aspect has been incorporated. So that also aspect needs to be taken care. So better to have a loan document in place so that when you are applying certain aspects of accounting standards or certain aspects of a statute of a different law, you are very clear that this particular aspect is a loan and this particular aspect is not loan. So this is the aspect which we come to know in our day-to-day practical scenario. That is why I just covered that aspect. Turnover aspect, I think more or less it is very clear that what is revenue from operations and other income. Still, while covering through the accounting standards, I have just highlighted certain aspects where we will just see. Yes, so we have 4 levels of entities, level 1, 2, 3, 4. By default, for level 1 entities, all accounting standards are applicable, including the disclosure aspect. For level 2, 3 and 4, accounting standard is applicable with certain exemptions or certain accounting standards by default is not applicable to them. For example, cash flow statement, AS20 earning per share, AS21 consolidated financial statements. So those are the aspects which are not applicable to non-corporate entities. First of all, before we start, I've often seen, in fact, it has been also been point of discussion where we actually don't give notes to accounts or accounting policies for non-corporate entities at times. See, in partnership firms we may, but of course in case of sole proprietary concern, we often don't give those particular aspects. So I would suggest to comply with it because this standard has to be complied in a true and fair manner. So it gives a more effective way of communication to the users of those financial statements. I understand it may not be that much useful to the proprietor himself, but once you just inform them that these need to be reported, it shows more effectiveness towards the audit quality which you perform. So as I said, AS3 cash flow statement is not applicable to level 2, 3 and 4. It is applicable to level 1 entities. And also let me tell you, once if on suo moto basis you are adhering to cash flow statement, once you have complied with it, you cannot discontinue that particular aspect. You have to comply with accounting standard AS3 for entities who have on suo moto basis adopted it, even if it is not mandated by the board. And certain accounting standards which I have taken where in common scenario, in practical day-to-day practice we come across, those particular accounting standards I have covered at large, so it is beneficial to all. And of course we can discuss any point if anyone has. So I would say AS12, like government grants, it is not a frequent transaction which a non-corporate entity would have, so that particular aspect. And segment reporting is also one of the accounting standard which is not made applicable to level 2, 3 and 4 entity. So friends, here we need to understand that these are the disclosures which we need to make. You can have a standard disclosure which has also been covered as one of the pointer at the end, that things which we can do as of now. Related party transaction, again one of the important accounting standard where we are less I would say less pondering upon those particular aspect, but we tend to disclose that because we have 48(2)(b in income tax. So we just comply with that particular aspect, but we never see the accounting standard aspect. So that also needs to be taken care. As I said, EPS AS21 consolidated financial statements is not applicable. Again, AS23 investments in CFS is also not applicable. AS25 interim financial reporting, AS27 reporting with interest in JVs, impairment and provisions for. So in all we have 27 accounting standards, and for level 2 and 3 as we see, there are certain accounting standards which is not applicable, and certain accounting standards where there is exemptions with regards to only disclosures. You have to follow, but you did not disclose. So that is particular with regards to disclosure aspect. So basic AS1, these are, so basically the objective is that based upon these following of the accounting standard, basically the financial statement is prepared. Like we fundamental accounting standard, that is going concern, it is assumed that the entity is a going concern and there is no a thought process for liquidation or in a short span of time. So it is presumed. You need not disclose this particular aspect. It is assumed unless and otherwise it has been stated specifically. Second is accrual. So these accrual aspect, and the third one is the consistency aspect. So you need to follow those accounting standards in a consistent manner. Accrual manner also, because we often come across the sole proprietary concern specifically who at times follow cash basis of accounting. So better to avoid that particular aspect. Change in accounting policy. Now change in method of depreciation, whether it amounts to a change in accounting policy or not. I follow say SLM method, then I change it over to WDV method. So whether that is a change in accounting policy or a change in accounting estimate. So friends, it is actually an accounting change in accounting policy. It is not a change in accounting estimate. Estimate, I would say that change in accounting estimate is the transaction where for example, we have actuarial valuation done in gratuity. We often calculate certain aspects based on assumptions, say attrition rate. I change the attrition rate. So that is the change in estimate, which does not bring in the change in policy. My policy, if I change the methodology, it affects my financial statement. So that is something which I will now follow. So that is a change in accounting policy. So just to highlight the accounting policy, specific accounting principles and methods of applying those principles in preparation and presentation of a financial statement, such as inventory valuation, cash flow statements, etc. Basic disclosures, significant accounting policies. We will just discuss on this particular aspect as well. Such disclosure, of course, should form part of financial, and it has to be disclosed, in at one place. Often we see that depreciation is shown with asset schedule. Significant accounting policy is shown somewhere else. Related party transaction is shown in below the profit and loss account, etc. So it gives more effectiveness when we disclose full accounting policy at one go. So the users with regards to those particular entities, it gets communicated effectively. So what are the non-compliance? First, inadequate disclosures of accounting policy. We tend not to disclose. First तो वही है कि disclose करते ही नहीं, बनाते ही नहीं accounting policy. So that itself is one of the non-compliance. So the AS1 mandates compulsory disclosure of accounting policy, and change therein the fact should be disclosed if there is any change in accounting policy. As I mentioned, change in method of depreciation. If there is any we need to disclose upon the in accounting policy. If it is not done, then the impact is that there is a lack of transparency, or even can say comparability amongst the competitors, industry, and of course without accounting policy it is an incomplete financial statement. Second non-compliance is with regards to accrual basis of accounting. As I said, we tend to at times also include transactions on cash basis. So we try to avoid that and account for on accrual basis. Change in accounting policy is done but without disclosure. So these are the basic non-compliance which has been observed and also has been highlighted by the FRRB board of the ICAI when it just published certain non-compliances. Valuation of inventory, the most important aspect for non-corporate entities. So inventory valuation is very important, because inventories are the assets which are basically held for sale in ordinary course of business, where you use certain materials in the production process, and the consumptions of those particular aspects are meant for delivering a finished goods or a service. So when we value how we value in fact the inventory, it is basically the lower of cost or NRV, whichever is lower. Now friends, with regards to manufacturing entities, we should disclose cost plus the conversion cost and the associated other costs which are aligned to inventory. And specifically in conversion cost, we should include certain overheads. Overheads meaning the fixed overheads and the variable overheads, based upon, of course, the capacity of production, the normal capacity of production. In case of trading concerns, we need not add, in fact, the administrative overheads, I would say. We should add the fixed overheads. So valuation aspects, friends, we need to just take care about, because in practical scenario, we have a habit to conclude the closing stock, whatever the client or whatever the assessee gives us. So just since we have time, the deadlines has been extended, better to focus on the accounting as well as the valuation aspect of inventory. The disclosure which we need to make for AS2 is the accounting policy which has been adopted and the carrying amount of the inventory. We often find in financial statement that for manufacturing entity, the inventory is shown as a closing stock. It has not been bifurcated, say, in raw material, work in progress, finished goods, or even you may say stores and spares, etc. So these particular aspects are to be disclosed because the valuation differs from what is the raw material and what is the work in progress and finished goods. So this particular aspect you need to take care, give bifurcations in your financial statement. Yes. Sir, administrative overheads is not to be allocated. Yeah. So fixed. Correct. So, with regards to fixed overheads, I will give a simple example is like if you incur a lease, if you incur a rent payments, if you incur electricity cost, these are the fixed overheads irrespective of your production. You can create a bucket of those particular aspects, no? Fixed overheads, which you can add it to the inventory. You allocate a bucket and this particular aspect needs to be added to the inventory. But sir, in case of medical, if you say that there are different stores and all, then it is a different aspect. Production, yes. So that is where I was coming, that now actually a medical store effectively is basically a sort of trading concern where it procures the medicines and sells it out. In that particular aspect, it incurs certain overheads. Now those are kind of administrative overhead which is not to be added to the cost of inventory. So basically the fixed overheads where I mentioned is the rent cost of the factory, electricity cost of the factory, not of the commercial office or the corporate office. Direct cost, which is in relation to your goods. Right. So in case of medical stores, irrespective of your production or irrespective of your sale of medicine, you will incur that particular electricity cost. You will have to pay the rent. So those particular stores are not correct. Yes, because they are trading concerns. They just procure and sell it out. So in case of no, yes, overhead is to be loaded for manufacturing. Like for example, if you consider cost of conversion, say a direct labor cost which I incur, it is part of cost of conversion. You load it to inventory. Yes, yes. So the medical store or general store is totally different this thing. So non-compliance with regards to valuation of inventory, AS2 is that improper valuation of inventory. At times we just value it at selling price. We don't value at the cost or NRV, whichever is lower. We often find certain industries, say chemical industry or steel industry, where the price of the product is very volatile. At the balance sheet date, say 31st of March, the product value will be 100. But subsequently, when we sign the financial statements, the NRV has fallen below the cost. It is at 80, for example. So where you will, what value you will allocate to inventory? Whether you will value it at 100 or will you value it at 80? It is cost or NRV, whichever is lower. It is at the balance sheet date, correct? Yeah, so you need to disclose this particular aspect also in, you will value it at 100, but you also need to disclose this aspect in your accounting policy. So there are entities who are also valuing at 80. It is cost or NRV, whichever is lower. At balance sheet date, I agree. But when you subsequently sell that product, in the market, no one will fetch 100. That so the argument of the panel was that there is inflated inventory and inflated profits. Balance sheet date, correct, correct. So that is what the standard says. Even where we said that this is what the standard says and a particular date. Had it been the reverse criteria that the cost has the NRV has gone up, still you would say that I will value at 100 because the cost is less. Over there, a conservative approach is adopted. But where the NRV has fallen below the cost, over there you cannot per se recognize at 80. Yes, over there your ratio gets changed. So that particular thing will come as a analytical view with regards to change in policy. It is actually not change in policy, but it does not follow the consistency. Consistency, yes. What I have said, sir, is the viewpoint of the panel as well. Yes, yes, yes. That is what I said now, that disclosure is to be done. You will value still at 100, but disclosure is to be done. Second non-compliance is the incorrect disclosure of valuation of inventory. See, AS2 requires correct disclosure of accounting policies which are adopted in measuring the inventory, including the cost formula and the total carrying amount of the inventory and its classification. I have mentioned specifically, that is raw material, WIP, FG. This SIT is stock in trade, stores and spares, which is as per para 3.2 of the AS. Another non-compliance with AS2 is the exclusion of overheads. We tend not to include overheads in inventory cost, so we need to take care about this particular aspect, of course with regards to manufacturing entities. Revenue recognition in case of non-corporate entity. Have we, friends, at any point of time verified that whether the revenue which has been recognized by client is correct or not? Or we tend to that, chalo, you have recognized 1,000 as your revenue, we accept 1,000, we don't check whether 1,000 is correct or not, whether it is 1,010 or 990. So it is better to check the recognition aspect. For instance, I will say export of goods on CIF basis and FOB basis. We are well aware about the provisions of recognition of revenue. So in case of FOB, export of goods, when should we recognize revenue? When it is boarded, we get the say bill of lading, etc., and we recognize the revenue. And say the goods have been shipped from my warehouse till the port, and it takes approximately 2 to 3 days. On 30th of March, the goods have went. It has been shipped that in the vessel on 2nd of April or 3rd of April. We often find that the client has recognized that particular aspect as revenue, whether it is correct or not. Of course, it is in you will categorize it separately, but we find that it is been recognized as a revenue. You never know that this particular this transaction has happened. It But sir, you only said that it is to be recognized when it is shipped or bill of lading, but bill of yeah. So you are saying that we will recognize revenue, or we will not recognize the revenue. Yeah, bill shipping that is there. That is of that is dated 2nd or 3rd of April. Vessel in case of FOB, because there over there my risk and rewards gets transferred. Correct. Sorry, sir. Yeah, once we ship it, it is. Hmm. But in the way, on the way to port, if something happens to the goods, who is responsible? Yeah, but usually we take insurance from the point of view of origin of port till the port which is destined. Not, but still, the practical scenario. I am talking about the practical scenario where. Bill of lading, correct. So that was with regards to FOB, where the goods have been shipped on 2nd or 3rd of April, and as the sir mentioned that it is, if it is X works contract with the seller, then it has been out from my godown on 30th of March, but shipped on 2nd or 3rd of April. So ideally, sir, as per the accounting standard, you will not recognize the revenue. You will recognize the revenue in the following financial year. Still, if at all we want to recognize revenue, we tend to see the past ratios of return of particular goods or damaged goods for that particular assessee or a non-corporate entity. Where there are no records of any damage, no records of goods getting returned, you can disclose, you can recognize revenue. Correct. Correct. That, sir, I agree. I understand the practical. Yes, yes. So this particular aspect we need to know face, where this, if it is not recognized, then we, that forms part of your reconciliation. You need to explain it to them. But we just tend to recognize so that we don't have to explain to the authorities. So that is the practical call which we take. Nobody till the time institute. So sir, that is where I was slowly coming to it. It was good that you came to that particular point, just to address that particular point where I have generated the e-invoice, e-way bill for the purpose of GST aspect. I will recognize the revenue so that my revenue in the GST law and the revenue in books matches, gets reconciled. There is no reconciliation item to be disclosed. So that is where we see the convenience, but still the risk and rewards gets transferred once I ship the goods, if in case of FOB. In this case of CIF, export of goods, destination, but it at times take maybe a week's time or 2 weeks time. So ideally in case of CIP it takes longer time, so you recognize revenue once it reaches the destination of the buyer's port. That is the time ideally where you need to recognize the revenue. Now this is what we saw with regards to goods. That is at the buyer's. In case of export, the importer is in some other country, so that is at the buyer's end. One point sir mentioned was very, yes, one point where sir mentioned is the in transit. So that is the a more appropriate and effective disclosure, it can be said. Yes. Another aspect, if we come to service, Service, in case of say a software development, two terms I would like to explain over here. Then we come to, of course, the non-compliance part. Unbilled revenue and unearned revenue. So unbilled revenue is the revenue which you are supposed to recognize, where you have not billed it effectively to the client or a customer. And unearned revenue is the revenue which you have received but it is not due. So unearned revenue will form part of your balance sheet item. It will not form part of your profit and loss. Unbilled revenue you will recognize as a revenue in your financial statements. So for example, there is a contract where the contract is such that the amount is received well before the start of the quarter, but where the services is yet to be delivered. So for the quarter 1st April to June, I receive advance in first week of April, and I am yet to provide service. So that particular aspect is actually unearned revenue. And unbilled revenue is that the task as per the contract terms is over, but it is not yet billed to the customer. So these two aspects I wanted to highlight. So AS9, as we all discussed, so the thought process was like, if we interact, we of course come to the points which the AS itself says, where we gave a thought process towards risk and rewards getting transferred to the buyer and so on. So recognition of revenue in case of sale of goods, significant risk and rewards is transferred, no effective control over goods of the seller, and no significant uncertainty exists regarding the amount of consideration. Of course, interest we recognize at time basis, royalty based on the contractual terms, and dividend right to receive. And with regards to services, PCM or CSCM method, proportionate is the proportionate degree of completion. Performance consists of execution of more than one contract. Recognize revenue by reference to performance of each act. If there are multiple contracts, so each contract needs to be evaluated. In case of completed service contract, rendering of service is completed or substantially completed, and service becomes chargeable. The performance consists of execution of it is basically adopted for a single contract. So what are the non-compliances? First is incorrect recognition of revenue, where we just don't ponder upon the recognition criteria of revenue, where it's the standard prescribes that risk and rewards, uncertainty to collectibility is to be checked. So this particular aspect needs to be verified. In case of services, we discussed incorrect recognition of revenue, where unearned revenue, if an unearned aspect is recognized as revenue, actually it is not a revenue, because you are yet to provide service. This we often see in case of say software development, and AMC has been provided by the entity. So AMC, if it is received in advance, it is to be considered as an advance, not as a revenue. So one particular aspect I have highlighted, incorrect revenue recognized, which is not in line with principles, which has been laid out by AS9. Entity has recognized as income the entire cost of garments destroyed by fire under other operating income, that is stock loss claim, based on the filing of insurance claim. With regards to this was with regards to goods which were completely destroyed. With regards to partially damaged stocks, the related inventory is valued at NRV, and insurance claim against the same is taken as other income. So there are two things to this. One is the stock getting damaged completely and partially, and second is the filing of insurance claim. So first and foremost thing, insurance claim filing and everything is not getting covered under the accounting standard AS9. Actually, it is a exceptional item, so which we should disclose separately on the face of profit and loss account. In case of filing of insurance claim of a particular stock, we don't know the exact amount. There is uncertainty with regards to amount which we are to receive. Second, if we deep dive it, we just see at what stage the insurance claim is and what is the percentile where we will get our claim. If it is certain that 90% will get our claim, so to that extent you will have to recognize and you will have to show it as an exceptional item. It is not to be shown under the head revenue recognition, because revenue recognition excludes insurance claims. So it was viewed that in case of sale of goods or rendering of service, recognition of insurance claim also requires that amount of realizable is measurable and is not unrealizable to expect the ultimate collection. Recognizing the insurance claim at the time of filing the claim itself is not correct unless and until we deep dive into the transaction, where we have on record that the claim is at this particular stage and the 90% claim will be received. But still we have not reached at that particular level, and recognizing revenue is not correct. It is the stage where I have just filed my claim. So recognition is to be done basis AS5, which is exceptional item, and certain points which I have just mentioned, that management estimate is to be seen that 90% is claim is will be received, etc. Stage at which the claim is with the insurance company, and a separate disclosure on the face of profit and loss account. So this particular aspect also needs to be taken care. Another non-compliance is the incorrect recognition of advance receipts as revenue. We discussed about this in a practical practical example where it is unearned revenue. So it is to be shown as an advance and to be recognized as revenue as and when the services are performed or delivered. Clubbing of non-operating income under sales. Such a certain examples is as I mentioned that insurance claim, scrap sale, etc. So these are the particular, we have observed that these are clubbed under the head revenue from operation. It is not shown separately under the head other income. So it is not a you're not violating anything, but it is not a correct presentation of a financial statement. We can see that there might be a change in the ratio when we compare with previous years. Coming to accounting standard 10, property, plant and equipment, that is fixed assets. So friends, these are the PPE actually is a tangible items which are used in for production of supply of goods or services. For rental to others, basically I am in the business of renting, so this is capitalized, and for administration purpose, which is expected to be used for more than 12 months. And when do we recognize the fixed asset? That it is probable that the future economic benefit will flow and the cost of the item can be measured. One of the quickest example I will highlight is that, say for example, an entity buys a machinery, right? We often in hurry or inadvertently just take the invoice of a machinery, account and machinery ka invoice liya, 1 lakh rupees, he has capitalized it. But what about the freight cost which brought the machinery to its present location? It has to be added to the cost of fixed asset. This is the aspect we tend to fail. So this particular aspect needs to be taken care. One more point, an enterprise may decide, and effectively it is reasonably fair enough to decide an expense, an item which could otherwise have been included in PPA. Certain limit can be formalized. Let, for example, anything below 5,000 is to be expensed out. So that particular aspect I have highlighted. One more practical example I will highlight is, say it is a manufacturing entity. It has a machinery where the life of machinery, say it may be 7 or 8 years, which has been prescribed by the statute. It is 7 years, and some part of that particular machinery is changed. What we tend to do is that when the part is changed or replaced, that particular part, we show it as a separate line item. Effectively, that machinery now has only 4 or 5 years of his life. We again allocate a fresh 7 or 8 years to that particular part or a component. If that machinery is not there, what the part or accessory will do there? So actually the life of that particular part which needs to be allocated is only 4, which is the remaining life of that particular main asset. If the main asset is not there, the part or component has no value. So this particular aspect you need to take care specifically in case of manufacturing entities. Subsequent expenditure, if there is any routine expenditure, that is repairs and etc., are to be expensed out. Addition and replacement, capitalize if the recognition criteria meets. Now with regards to replacement of fixed asset, I'll give you an example so that we get just interact amongst ourselves. I have a car, motor vehicle, for which WDV is say 8 lakhs as at 31st of March 2025. The entity wants to buy a new car. The new car cost 15 lakhs. The car dealer said, whatever car you have, I'll give you 6 lakhs for this particular car. You give only differential 9 lakhs to me. So the entity said, fair enough. So what will be the cost at which I will recognize the new motor vehicle in my fixed asset schedule? See, 3 events. One, I have old car which is having a WDV of 8 lakhs. Second, the car dealer is giving me 6 lakhs for that particular motor vehicle. Third event, the new motor vehicle cost me 15 lakhs. I pay only 9 lakhs differential to him. What is the value at which the new motor vehicle I will recognize in my fixed asset? Correct. All are on the same page that we'll recognize at 15 lakhs. Correct. We will first remove the old car from my schedule because that is mandated. I will not get 6 lakhs, but that is the value where I have returned my car. So just to highlight where where he is giving me 6 lakhs and my WDV is 8 lakhs. So ideally 2 lakhs is my loss. So that loss I will recognize. 15 lakhs new value of asset I will recognize and apply depreciation, etc. Correct. And from that bank account, my 9 lakhs will flow to the dealer. So the accounting entry will go as if, say for example, car dealer account debit 6 lakhs, loss account debit 2 lakhs, to old motor vehicle, that is 8 lakhs. First thing I have done is removing the old motor vehicle. Coming to second, that is the bank transaction which I will do. So what I will do is car dealer account debit 9 lakhs to bank 9 lakhs. And third, now effectively the car dealer account is डेबिटेड बाय 15 lakhs. 9 lakhs मैंने पैसा दिया उसको और फर्स्ट ट्रांजेक्शन एक्सचेंज वैल्यू. अभी थर्ड एंट्री, नाउ आई हैव टू रिकॉग्नाइज फिक्स्ड एसेट ऑफ 15 lakhs. Correct? So what effectively entry will I pass? A JV or so. New motor vehicle account debit in fixed asset to car dealer 15 lakhs. Only then my car dealer account will get closed and my recognition of 15 lakhs has happened. My loss has been taken care. So this is the broad flow of entry. So the thought process was to correct treatment. If we go step by step, first removing the old asset, second the bank entry which the entity gives, and third recognizing the fixed asset, new fixed asset. So on the depreciation part, of course, it is to be provided on estimated life or method of depreciation. Of course, if there is any change in the method, then it has to be a prospective effect, which is different than the Ind AS particular aspect. So the non-compliance with regards to AS 10. First is wrong classification of capital and revenue expenditure. We tend to, reverse at times the transactions. What are capital, we treat it as revenue, and vice versa, revenue as a capital. Second is incorrect and non-capitalization of borrowing cost. This particular aspect I will also take up with AS 16, which we will look upon, where you have say a qualifying asset which is under development. So whatever the cost, borrowing cost you incur till the QA, that is qualifying asset, is ready for its intended use, you need to capitalize that particular interest borrowing cost to the fixed asset. That is what AS 16 says, and which also is to be read with AS 10. Third is the non-disclosure of different depreciation rates, which if rates are wrongly applied, so that needs to be corrected and properly disclosed. Wrong head of classification of parts or accessories. As I said, that if any parts or components of a main asset is purchased or replaced, it has to be the remaining life of that particular aspect, or the remaining rate, effective rate, is to be adjusted for the remaining life of the main asset. You need not allocate fresh useful life to that particular part or accessory. Incorrect treatment in case of replacement. Replacement we discussed by way of an example. So if we break the transaction, it becomes easier to recognize and give a correct treatment to replacement of asset. No impairment assessment for idle or underutilized assets. We often find say a generator lying in the factory or office premises, but it has been almost 2 years, 3 years of time, but when we actually require the generator for its use, actually it is not working. We have to just call certain persons and make it work in what we do. So these particular aspects you need to check whether there are any idle assets lying in the schedule. Coming to AS 11. So of course, which we are discussing with regards to non-corporate entities, but if you have any queries, we can discuss. The standard is basically applicable for accounting of transactions in foreign currencies, in translating the financial statements of foreign operations, and accounting for foreign currency transactions in nature of forward exchange contract. So in case of NC, usually we have at large buy sale product. We don't have foreign borrowings actually for non-corporate, very rare situations. So monetary items, but I have just highlighted the basic points so that we just relearn or revisit to the accounting standard. That monetary items basically are the items which are easily liquidated or which are realizable within the span of next 1 year. So it is basically the debtors or creditors or cash aspect or etc. So monetary money held and assets and liabilities to be received or paid in fixed or where it is determinable. And in case of non-monetary, it is other than monetary item. Friends, we need to take care with regards to monetary item. Monetary item is to be revalued at balance sheet date. This aspect you need to take care. We often find that those monetary assets are not revalued. So initial recognition aspect, a foreign currency transaction should be recorded on initial recognition in the reporting currency by applying to the foreign currency amount the exchange rate between the reporting currency and the foreign currency at the date of transaction. So basically recognize the transaction at the time when it has been executed. And to effectively explain this, for example, say when we at times receive foreign currency, we have a sale transaction, we receive foreign currency. We often see bank charges certain charges or commission. So what is the habit of accountant is that whatever is the difference, he will just show it as capital array, a gain or loss. But actually what the bank charges, it gives you a bank advice or a letter where it is specifically mentioned that these are towards the bank commission or bank charge. That particular aspect needs to be disclosed as foreign bank charges. It should not go in gain or loss, right? At times you may even claim a credit of that particular because it will get reflected in your GSTR 2B if GST is given to the bank. So this particular aspect you need to take care. So non-compliance with regards to AS 11 is the effect of changes, which is effective changes in foreign exchange. Non-disclosure of exchange gain or loss. An enterprise should disclose the amount of exchange differences included in the profit and loss separately, which is as per para 40A. Second is non-translation of monetary items at exchange rate. As I said that as at balance sheet date, you need to revalue your monetary items and recognize the gain or loss accordingly. So at each balance sheet date, foreign currency monetary items should be reported using the closing rates. Observation with regards to that was either transaction at balance sheet is not done or all the foreign assets including the non-monetary are revalued. So non-monetary assets are not to be revalued, only the monetary assets are to be revalued. Third is incorrect exchange rates applied to monetary items which are hedged, which are covered by forward contracts. So we have a situation where at each balance, so forward contracts, and that is forward contracts is basically hedging my exposure, correct? And say transaction of a receivable. So these both are actually a different transaction. So you cannot merge this particular both the transaction, where I recognize my my receivable based on the exchange contract rate. I have to revalue the receivable as at balance sheet date, and then I'll revalue it again at the time of contract when it gets where I have taken a hedge from the bank. So these two are a separate transaction. Still, irrespective of the fact that whether you have hedged or not, you will revalue your monetary item, and whenever the hedging gets executed, that is a separate thing. So that does not give us leeway against revaluing as at balance sheet date. Yes, sir. As on balance sheet date? Oh. No, we have to account it. We have to account it, yes. whatever is the exchange rate as at 31st or 30th of March, you have to give, if you can account it as a gain or loss. And whenever the subsequent year, whenever the transaction crystallizes, like it gets closed, the yes, correct. So friends, we saw certain accounting standard which we have covered at large, and accounting AS 13, accounting for investments also I have taken. Specifically the current investment part for non-corporate entities. So current investments basically which are readily realizable and which are held for not more than 12 months or 1 year, and long-term investments which are not a current investments. Carrying amount of current investments. The carrying amount for current investment is the cost or FV, that is fair value, whichever is lower. And where investment for which the active market value generally provides the fair value of a particular investment. This particular aspect I have just focused specifically. Any reduction in fair value of investment is debited to P&L. However, if the fair value is increased subsequently, the increase up to the cost of the investment is recognized in P&L, and any further increase above the cost is to be ignored. It is not to be recognized. So this aspect we need to take care. Only up to the cost it is to be recognized in P&L. And of course the prudent method is to carry the investment individually, while revalue it individually. Of course you can give it as a classification class of investments, but you need to revalue it. Carrying amount of long-term investments carried at cost, valuation is determined on an individual investment basis. So friends, tell me, I have taken a borrowing for which I have as a security, I have given a fixed deposit. Borrowings of, for example, 1000 and 100 as a fixed deposit. Now borrowing I have taken for 2 years. It is a 2-year span. I have given 100 rupees as fixed deposit against such borrowing to the bank. I show this FD as current investments. Whether it is correct or not, this FD will get released when the borrowings are closed. A simple example. So actually this fixed asset should not go in my current investment, because I will realize this fixed asset only when the borrowings are closed, which is after 2 years. So fixed deposit aspect we need to take care, that we tend to disclose fixed deposit in current investments and go ahead, but we never bother to see the periodicity of fixed asset. So current investment, the standard is very clear, where I have mentioned in the first point itself, basically which are readily realizable and which are held for not more than 12 months. So what are the non-compliances? Is the not revaluing the investment first, not revaluing the investment at fair value where it is required. Of course, these are to be done when we enter into stocks related transactions. So this particular aspect needs to be taken care. I have highlighted paras wherever is easy and effective way for communicating. And incorrect treatment, second non-compliance, incorrect treatment for classifying FD as current investments, we discussed by way of an example. Yes, coming to AS 15, that is employee benefits. Now I understand that for non-corporate entities, asking them to go for compliance with regards to actuarial valuation, compliance with regards to PF, ESIC. Actually, it is not practical enough. But friends, we need to understand that at least we should communicate this to client that this is applicable, so that tomorrow if there is anything wrong happening or there is any notice, he will come to you only, that this has come now, how to address this particular notice. So it is better to comply with this, of course, ESIC and PF. So just inform client with regards to actuarial valuation compliance for ESIC, PF, EPF, etc. So employee benefits is basically recognizing my liabilities as on my future liabilities. Actuarial valuation क्या करता है? Basically it recognizes my liability now for which I have to pay in future. So entity knows what is the exact liability it has to pay. So better to comply with the accounting standard to the extent possible, but I understand the practical difficulty, but at least we should inform the client about the compliance aspect. So the scope, it applies to all entities. There is no exemption or so. So it applies to all entities for accounting and disclosure of employment. Of course, there is certain aspects exemption for disclosure, but applicability is to all, whether the benefit is short term or long term, or in case of termination. Benefits are basically classified in 4 categories. I've highlighted in 4 categories: short term, the post employment, the other long term, and the termination. Recognition and measure, the entity shall recognize service cost. This particular aspect comes when you go for actuarial valuation. So better to, even for corporate entities, I would suggest them for going for actuarial valuation, so that they come to know what exactly is their liability. Defined contribution plan, employer's liability is limited to fixed contribution recognized as an expense when incurred, and disclosure is to be made. Defined benefit plan, which is the pension, leave encashment, gratuity, etc. As I mentioned, there is full disclosure requirement with regards to employee benefits, which includes reconciliations, planned assets, assumptions. So that is where I said that, in actuarial valuation, when there is a change in the attrition rate, that amounts to change in the estimate. It does not amount to change in accounting. That also goes as an disclosure in your notes to accounts to financial statements. So what are the non-compliances? First non-compliance will be not adhering to the ESIC PF itself, because we have a lot of corporate entities who do not adhere to at least the PF ESIC aspect. So that needs to be communicated to the client effectively. No proper disclosure. First is no proper disclosure of employee benefits. See, employee benefits, you need to disclose certain aspect, that what is salary, what is bonus, what is incentive. These particular aspects need to be disclosed separately in your financial statements. Entity should disclose information that enable the users to evaluate the nature of its defined benefit and financial effect. The second non-compliance is the absence of actuarial valuation for defined benefit plan. It is better to have actuarial valuation, and I think it is not that costly. It is if you incur certain hardly amount of XYZ, then get the actual valuation done and recognize your liability now. Non-disclosure of defined contribution plan. In order to measure the present value of your post-employment benefit or obligations which are to come, it is to be necessary to be disclosed and apply the actual value assumptions, attribute benefits to period of service, and make actual assumptions. So as I said, that many non-corporate entities do not disclose the employee benefit aspect in line with accounting standard. So better to disclose that particular aspect. No disclosure of defined contribution to it. At times the NCE, that is non-corporate entity, do contribute to PF, ESIC and all, but we don't disclose that in our accounting policy. So once we disclose that, the users of the financial statement will be have a different perspective to read that particular financial statement. Coming to borrowing cost. So borrowing cost effectively for non-corporate entities at large, it is applicable when you are in the process of either constructing a particular qualifying asset, I would say a plant and machinery or a power generation unit, where it takes considerable time for an asset to get ready for its intended use. So that particular aspect we will discuss, and of course the interest parts which we discussed during AS10 will also have a relook in AS16. So borrowing cost are interest and other costs incurred by an enterprise in connection with the borrowing of funds. A qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use. See, ready to use, intended use, but whether it is put to use is a different thing. It should be ready for the use for which it is intended. And borrowing cost may include certain charges, that is interest, commission, commitment charges, finance charges, etc. The recognition criteria, that is the at what point of time we will recognize the cost, that is directly attributable to the acquisition, construction or production. So recognition criteria of a qualifying asset, I am referring to that, not the interest cost which is incurred. Suspension in case of interruptions. So if there is any temporary temporary phase where there could not be continuous activity with regards to construction or acquisition of plant and machinery, so temporary aspect need not hinder the process of recognition of my interest cost to the qualifying asset. And cessation, that is the closure of recognition of interest component for a qualifying asset, stops when the qualifying asset is ready for its intended use. So these all particular aspects needs to be disclosed in your financial statements by way of notes to accounts in attached to FS. So non-compliance is failure to capitalize the borrowing cost for a qualifying asset, borrowing cost that are directly attributable to the acquisition or construction is to be capitalized, and lack of disclosure on accounting policy of a borrowing cost. Related party transactions. So related party transactions, we should actually not see it from the perspective of Income Tax Act, but yes. Okay. Okay. Right. Right. Yes, so that particular borrowing, that is the OD facility which has been availed, actually it is for general purpose. Now we need to allocate certain aspect to the borrowing cost because it has been utilized for that particular aspect, for the constructing your qualifying asset. So the part in a systematic method is prescribed that how you need to allocate that particular borrowings cost to the qualifying asset. But yes, you have to recognize. Related party transactions. First and foremost, we need to take the related party transactions list from the client itself. Of course, we know who are the relatives to those particular clients. Since we are acquainted with them for years, but better to have that as a document so that it becomes your documentation part as well. So parties are considered to be relative if at any time during the reporting period one party has a ability to control the other party or exercise significant influence over the other party. Control ownership, we are aware. Significant influence, we are aware. Of course, significant influence at times is debatable whether it amounts to significant influence or not. Relative in relation to an individual means a spouse. We need not get confused with regards to relative, which is prescribed under Income Tax Act, and what is there in accounting standard. So we need to take care about that. So relative in relation to an individual means the spouse, son, daughter, brother, sister, mother, father, who may be expected to influence or be influenced by that individual is her dealings with the reporting enterprise. So if there is any transaction by an entity with regards to any of the person of an individual who are their son, spouse, mother, brother, brother, sister, or father or mother, is a related party transaction. Basic disclosure has to be made. See, we of course at times show those related party transactions in our 3CB, 3CD report, but we don't show that transactions in our financial statements. I mean financial statements in the accounting policy. So better to show that particular aspect also in your financial statement, because what will happen is, the practical situation where, if there is any scrutiny assessment, you only have to show it separately by way of ledger and explanation to the authorities. If it has been separately disclosed, which is there in your which is a forming part of your financial statement, effectively the authorities will come to know that this particular disclosure has been made and is in line with the accounting standard and the income tax laws as well. So name, description of the relation, description of the transaction, the volume, and the outstanding amount. The transaction value and the outstanding amount both has to be shown in your notes to accounts. So first non-compliance is that we don't disclose only those related party transactions. Second is complete failure to identify a particular transaction as related party transaction. We often, of course, we often see related party transaction from the point of view of transaction which are there in P&L, but we do not see the transaction which are there in the balance sheet, loan transactions, etc. So those particular items also you need to show as a related party transaction in your notes to accounts. Coming to AS 19 lease, that is so the basic objective of lease is that the standard is to prescribe for lessees and the lessors the appropriate accounting policy. Here I have just covered one practical example by way of illustration, so it gets communicated effectively. The appropriate accounting policies and disclosure in relation to a finance lease and an operating lease. पहले तो lease transaction को identify करना है, whether it is a operating lease or a finance lease. What are the criteria where you will identify a particular lease as a finance lease or a operating lease? So I've just highlighted certain aspects which gives you a direction that this particular lease is a finance lease. It is where yes. Yes, it falls under the criteria of AS accounting standard 19. Within the year, yes. If it is 11 months, so yes, it has to be as per AS 19. Yeah, so a finance lease. What are the criteria which takes us to classifying a transaction or classifying rather a lease as a finance lease, where there is a transfer of ownership to the lessee. The lessee has the option to purchase the asset at a price which is substantially lower than the fair value of that particular asset at the time of exercising this option. This is usually at the end of the lease term, where the lessor gives an option to the lessee to repurchase this, to purchase this asset. The lease term is for the major part of the economic life of the asset. Say for example, asset is ideally having a useful life of 5 years. It has been leased out for 4 years. So it is more than major part of the economic life of the asset is getting covered by 4 years, more than 50%. So it is the leased asset is a specialized asset which only a lessee can use it. So it is a customized one. So these particular points are the points which takes us to a conclusion that this particular lease transaction is a finance lease transaction and not a operating lease transaction. But in our practical scenario, we often come across a operating lease transaction. There are very rare situations, or maybe at times we come across a lease transaction which is a finance lease. The lessee will disclose, in case of course, the finance lease, the lessee will disclose the finance lease as asset and liability at lower of fair value or the present value of the minimum lease payment throughout the lease term, whichever is lower, using the interest rates applicable, or if interest rate is not applicable, the borrowing rates which is there in the industry. And the lease payment should be apportioned between the finance charge and the reduction of the outstanding liability. So this is a bit complicated with regards to finance lease. I've specifically covered the operating lease part because that is the aspect where we need to come across in our practice. So lease payments under operating lease should be recognized as an expense in statement of profit and loss on a straight line basis, SLM basis, over the lease term, unless other more effective pattern is used for user benefit. It is more effective to disclose in a particular way. So before going into non-compliance, we will just see an example of an operating lease. Just give me just a minute. Sorry. So we just see this example where a lessor, ABC Properties Private Limited. First of all, we account lease in a practical scenario on payment basis, so that apna sab match ho, TDS, GST, this, that. But actually that is not the manner in which the accounting standard says. What the accounting standards say is that you need to apportion the lease payment on a straight line basis. Now what is this straight line? It has been explained with as well of an example. Say a lessor ABC Private Limited and a non-corporate XYZ is a lessee. The asset leased is the office premises. The lease term is 3 years with 2 years lock-in. What is the lease payment is? 12 lakhs in first year with 5% escalation every year. So in all, how much lease payment I have to make in 3 years is 37,83,000. 12 lakhs in 1 year, 12,60,000 in the second year, and 13,23,000 in the third year. Now the correct treatment of SLM is total lease is 3783. The number of years of lease term is 3. The annual lease which is to be recognized is 12,61,000. This we get it by dividing 37,83,000 by 3. That is the lease term period. So what is the monthly lease is 1,05,083 and not 1 lakh, which is the payment done to the lessor. So I will recognize in my profit and loss account the lease expenses 1,05,000 and not 1 lakh. For the time being, we don't look upon the TDS part, etc. TDS, of course, we will deduct on 1 lakh. but that has been just for better understanding. I have just ignored that particular. So lease expense account debit 1,05,000. The bank account will get credited by 1 lakh, and lease equalization levy account will be credited by 5,000. This account of lease equalization levy at the end of the year will get nullified. So this is the correct treatment of lease transaction for operating lease on SLM basis. But we tend to account it on payment basis, that is 1 lakh every month. So I again just highlight that lease payments. So of course the illustration which we saw is an operating lease, because none of the criteria for finance lease gets attracted to those particular. We often come across such transaction in our practical world. So just I'll read again for the benefit of all, that lease payments under an operating lease should be recognized as an expense in the statement of profit and loss on a straight line basis over the lease term, unless there is more effective way for disclosure. So this is the manner in which you will have to disclose a lease transaction. You need to also have a working of this particular aspect and make a disclosure in your notes to accounts to financial statement. Then you have to at 2 years itself you have to get it nullified. Yes, that is an event which you do. If you so that is this entry I recognize at a time where I don't know whether I'll cancel my lease after 2 years. You will reverse this transaction, get it nullified. You reverse it. Yes, yes. We have come across this particular method as well in banks, where bank takes premises on lease of 2 years, 3 years. They even recognize this particular method even if there is no lock-in period. So it says straight line basis. So no, this is particular, sir, for only lease transactions. Actually, there is no a purpose per se getting served by the users of the financial statement. Actually, exactly. Even not even for the authorities, I would say. So, but this is what the accounting standard says. And but what happens, sir? But what happens is, what gets triggered over here is the deferred tax component. Because under income tax law, sir, for example, you are recognizing expenses 1,05,000, correct? But in income tax law, you will be allowed only 1 lakh as a deduction. One more reconciliation. Client will not do reconciliation. That is how the accounting standard goes. So. Client, what is the purpose getting? So, so we can increase our audit fees by this. True. True. At times we just think on that particular aspect. That is a compromising aspect which we do. To no, but sir, I'll tell you. No, no, correct. But sir, I'll tell you, the listed entities, the big corporates do follow this method of lease transaction. Yes. Prepare balance. That is where I said, sir, our first non-compliance is whether we tend to give accounting policy itself with the financial statement. Mhm. Manage कर ले. No, I understand, but that is the actually viewpoint. So if we bring in change, then the change will come ultimately. So, common non-compliance with regards to AS19 is the non-disclosure, improper classification of a lease, whether it is operating lease or a finance lease. And as we saw in illustration, that failure to recognize lease payments on SLM basis, that is straight line method basis. AS22, which is accounting for taxes on income. But before going into this, whether actually we recognize deferred tax for non-corporate entities. We I understand, see, completely understand, because we often go through that particular aspect where, so that is what has been prescribed by way of accounting standard, which we all have read during our examination. So, but sir, I'll tell you a practical situation where now we have this 43B at 45-day payment rule, right? If it is not paid, you have to disallow it. See, ideally वो छोड़ देते aspect where who follows, who does not follow. Correct? पहले तो disallow करना है, फिर जब subsequent year में pay करेगा उसको allow करना है, तो उसके लिए deferred tax नहीं ये रहेगा. I agree that recognizing deferred tax will not make any sense to the proprietor or a partnership firm, but whether the deferred tax aspect will get triggered, a practical scenario, it will get triggered, correct? So my point is, we just inform the client whether he wants to adopt it or not is his aspect. We disclose that accordingly in our accounting significant accounting policy. Of course, we don't disclose that this has not been followed, but in a more effective way. So that is where I want to highlight for AS22, that is accounting for taxes on income. The objective of the standard is to account for the taxes. The accounting income basically is the, of course, I understand that for non-corporate entities we only consider depreciation as the difference between the accounting income and the taxable income, correct? But once we see the previous accounting standards, that if ESIC PF has been followed, but if it is not paid on time, so that also gets disallowed. Whether it is temporary difference or a permanent difference, that is a separate thing. Then 43B at 45 days payment is not made, it has been made. So those particular aspects, we we come across where we know just adopt those particular transactions in the way the accounting standard. Of course, I understand that for AS19 recognizing the SLM is bit tedious task, but that is how it goes, that accounting standard has prescribed. So deferred tax is the tax effect of the timing difference basically, and deferred tax should be recognized for all the timing difference subject to the consideration of prudence in the respect of deferred tax assets. At times we have even come across where deferred tax asset is recognized where there is no foreseeable benefit reversal happening in the subsequent year. So that is also aspect which we need to see. So for example, there is a concern over going concern. Why to recognize a deferred tax? There is no need to recognize a deferred tax. Just give a disclosure in notes and close the issue. So that is the aspect where we need to just see. You will include the surcharge for the tax rate, yes. So that is but the tax, but that is the aspect which you will pay it. Correct. You will also get benefit when you come below the threshold of the surcharge. At that point of time, you apply the lower rate of tax. When we come across, of course, this is for non-corporate. For corporate entities, if it follows new tax regime, we levy 25.17 as a flat rate of tax. Corporate is a different, but for two separate. Yes. You will apply the full rate of tax applicable. So the non-compliance part is the non-adherence to the recognition of the deferred tax itself at first tense, and the second is non-disclosure of deferred tax asset liability. See, I understand that certain aspects which are apparent, that is ESIC, PF, everything. At least on that particular aspect, we can just calculate the deferred tax and recognize that and make disclosures accordingly. So this was with AS 22. Deferred tax asset is recognized without reasonable ascertaining certainty of future benefits, future profits. Deferred tax should be recognized and carried forward only to the extent that there is reasonable certainty that sufficient future taxable income will be available against which the DTA can be realized. So this particular aspect comes in a scenario where you have a concern with regards to going concern. There is a doubt over that particular aspect, you don't recognize deferred tax. So observation is by the institute is the entities recognized DTA when there are continuous losses and here, of course, the net worth has irrelevant, no certainty exists, or it is not clear as to whether there exists reasonable certainty. So over there also deferred tax assets are recognized, which is not to be done. Fourth non-compliance is the non-reversal of deferred tax asset, deferred tax liability at each balance sheet date. So if at all you come across situation where taking the same example of going concern where you're not certain that no, so you reverse the deferred tax whatever is the asset or liability. Of course, the amount which is there in the deferred tax may be pertaining to earlier years. You get it nullified. Now coming to this last 2-3 accounting standards, intangible assets. सर वो टैली का सॉफ्टवेयर लिया सीधा कैपिटलाइज कर दिया एज इंटेंजिबल असेट. So that is not the of course actually the license which we purchase is to be considered as a intangible asset, not the renewal aspect or the AMC aspect of the software. So just or a trademark fee or a licensing fee or a factory license we come across, if there is interest. So basically it has to be an asset for me. So marketing fee incurred, trademark fee incurred, those are not actually per se an asset. It has been incurred to protect my, say, trademark brand, etc. So it should fulfill my asset criteria. What is an asset? An asset is a resource which is controlled by an enterprise as a result of past events and from which future economic benefits are expected to flow to the enterprise. So marketing fee, of course, control meaning need not be that of course the expenditure which the entity does is in its control, but not in that particular aspect. We need to read that. We have to see whether that particular expense or a capital expenditure is incurred which fulfills the criteria for recognizing it as an intangible asset. If we say yes, license purchased for a software, it is an intangible asset. The license is an intangible asset. So a non-compliance is the capitalizing the expenditure that does not meet the criteria. So the facts of the case is that the expenditure incurred on factory license, the trademark fees, marketing expense has been treated as a deferred revenue expenditure which are being amortized over the life of the concerned asset. So the various expenditure incurred cannot be said to be a resource which are being controlled by an enterprise, and it also does not meet the criteria of recognizing that as an asset. So this should be recognized as an expense at first instance itself. Often also I'll just highlight since this particular aspect is that marketing expenditure has been incurred for which the benefit to an entity will flow in the subsequent year. So in that particular case, actually that is the deferred revenue expenditure, because the flow of the benefit will happen in subsequent year, but that does not take it to the intangible asset. Second non-compliance for intangible asset, non-disclosure of the accounting policy of intangible asset. So we need to also disclose the accounting policy for intangible asset. What is the intangible asset? What is the life of the intangible asset? And how are we amortizing the intangible asset? The last accounting standard, which is provisions, contingent liability and contingent asset. The objective basically is to ensure that all the provisions for the known liabilities have been recognized and contingent liability has also been disclosed. Now during our session, one of the member just mentioned that, for example, the balance sheet date has gone, that is 31st March, and before signing there is a tax notice to the assessee which is having a substantial amount. Should we, rather do we se zyada should we disclose that as a contingent liability? It can be of earlier years. Of course, the client based on this notice is sure that the it is of course not a note. It is a notice. It is a notice. For example, GST का example ले लेते हैं, where a particular entity has charged GST of 12% instead of 18%. Department is of the view, no, it is 18%. You paid the differential 6% right from 2017 onwards. Amount is substantial along with interest. So whether you will show that particular aspect in contingent liability or make any provision for expense. Notice is a so this is the view. First stance is the notice which has come. Of course, the management is of the view that they will contest it. But just to add one point over here, for contesting, you need to incur two things. One is the legal cost, which you will have to pay to a professional or a lawyer. And second, if you come across an order saying that is to be paid, the assessee denies that I am liable to 12% only. You have to pay say 10% or 20% of the tax amount and litigate it. It is certain that some percentage you have to pay if you are going to litigate. It is certain that you will incur certain professional fee or a legal fee. Right. So this particular aspect you need to inform the client and make a provision, or if at all at least show a disclosure of contingent liability. Of course, when there is notice only coming to the taxpayer, you did not show as a contingent liability, but the stage at which the notice is and what is the reply of a taxpayer, based on that you just decide whether it is to be disclosed as a contingent liability. If there is a demand coming, if it is going to be against, okay, yes, I was supposed to pay 18%, you straight away recognize the differential 6% as your liability. So that is the practical scenario which I highlighted, which we come across. So this particular aspect we just need to take care, where if we come across certain situations. So a contingent liability is a possible obligation that arises from past events and the existence of which will be confirmed only by the occurrence or non-occurrence of one or more uncertain event, not wholly within the control of an enterprise, or a present obligation that arises from past events but is not recognized because it is not probable of the outflow of resources embedding that economic benefit which will be required to settle the obligation, or a reliable estimate to amount of the obligation cannot be made. So this is with regards to contingent liability. If we have anything on this contingent liability, the example which we discussed, we can take it. So non-compliance for AS29 is at first tense is the non-disclosure of provisions contingent liability. As I said that we tend not to disclose it under contingent liability, but you just need to check at what stage the notice is and what is the likely outcome of those particular proceedings. And non-recognition of a provision. Example I have taken, the entity has not provided for interest on the ground that they are anticipating a favorable outcome in respect of an ongoing negotiation with the bankers for one-time settlement of their dues. The entity has borrowed funds, it has not repaid, and they are coming to a conclusion where there is going to be a one-time settlement. So any loan, even if under negotiation, some XYZ part or some certain part of the outstanding dues needs to be paid. Of course, not the 100%, or rather we may say 50% or 40%. So based on the stage at which the negotiation is, you need to make a recognition of the possible outflow which the entity has to incur. So any loan, even if under negotiation with the bankers for one-time settlement, does not exempt the entity from its obligation to pay if there are any associated related charges. So provision has to be made with regards to certain charges which is, possible that entity will have to pay. That we come across where we can ask for minutes of those negotiations with the bankers. We often get the minutes of the, or a letter which has been documented where the negotiations are going on. You can reverse it. So, sir, so that is where, sir, you will recognize in give a specific disclosure, because you are recognizing because of certain aspect which made you to, make a provision for that particular item. You will also give a disclosure so that the user of this financial will come to know, no, okay, this is the transaction getting highlighted and where the provision has been made. Uh, yeah, so on the comparison part, of course, whenever certain thing, certain transaction gets recognized as a provision, it will always give an incomparable ratios or figures. So if it is probable that, for example, as you said, that you are recognizing 25 lakhs and out of 25 lakhs you had to pay, for example, 15 lakhs, then you will reverse only to the extent of 10 lakhs. So whatever you have done in the first stage is correct. वो तो सर at any point of time आने ही वाला है, that it will not be comparable. No, this is the situation when there is only a default and one-time settlement happening. No, in normal case, where the borrowings are taken, where you will incur the interest-related charges, say a one-time charge, documentation charge, etc. That you recognize at the time when it happens, not in normal course of business. So this was with regards to certain accounting standards which is at large applicable to non-corporate entities, and certain pointers which I have just highlighted which we can use for the time which we have. See, first of all, determine the entity levels based on the criteria given by the ICAI. And we can just note it down in a tabular format that this particular entities are getting covered under level 1, level 2, level 3. Then we can just prepare a draft note for each level of entity, basic note as a format. Then for this particular specific client, we can modify that note. So those notes will form part of your financial statement as in compliance with AS1. We can have a master list of accounting standards. Once classification is done, we have a list of accounting standards which are applicable. Also, though we are not following, but we will be aware that this particular AS has not been followed. Revenue recognition. Communicate now itself to the client that what are the aspects of revenue expenditure specifically with regards to export transactions, or if your client is into service transaction, then the recognition of revenue in case of services. Capitalization of asset. Take a thorough verification whether that particular asset classifies the criteria for capitalizing, whether it is tangible or intangible. Foreign exchange. So these are the points, where it covers lot of aspects, where if it has been adhered to, it will reduce your line of work at the time of finalization, and it will be presented more effectively. Employee benefit, of course, communicate applicability of PF, ESICs, actual valuation, requirements to the clients. Whether to follow or not is up to the client, but you should in a way effectively communicate it to them. Related party transaction, take a list of related party transactions from the client and document it after verifying it. It will reduce your time at the time of finalization. Based on that, identify what are the related party transactions executed by the entity. Not necessary whatever list which has been obtained from the client, the entity has entered into a transaction with our related party. Lease, as we discussed, if you are going by the SLM method, if you want to recognize on the SLM basis, prepare a working. I'll tell you, it does not take more than half an hour's time to prepare the working. Prepare the impact of deferred tax, because these are the pointers which I have highlighted, which we can do as of now, which will help us in finalizing the accounts in a much quicker way. Prepare the deferred tax calculations, and wherever required, because we come to know that what 43BEH etc., which has not been followed. So this was with regards to certain pointers for non-compliance to accounting standards. So if we have any point or accounting standard to discuss, we can discuss, or any clarifications which you want. AS? Related party, yes. Significant influence, yes, okay. Correct. No, this is the disclosure in the notes to accounts. In case of significant influence, 51% criteria is not to be seen. That is why I mentioned significant influence need not be that I hold minimum 51% in the entity. It can be a significant influence by way of any reason. Not necessary I need to hold 51%. 51% से ज़्यादा हो गया तो in case of corporate तो वो तो मेरा subsidiary हो जाएगा. But what point you have highlighted is that we need to be vigilant enough that whatever is disclosed in my notes to accounts as RPT also goes in my 3CD. If there is anything which is not to be reported, vice versa, either in notes or in 3CD, I should be taking necessary actions accordingly, yes. Because the authorities के पास तो पूरा financial statements जाता है along with notes, so they can highlight that particular. So we need to be vigilant with regards to that. Whatever has been disclosed needs to be reported. So that is where I have mentioned one of the pointers, where you identify, abhi se identify करके रखो, which will help you in finalizing in a more effective way. They have no, the accounting standard has been followed, but there is no balance outstanding in balance sheet. So accordingly disclosure will come that the assessee, so the basic accounting standard, yes. So if there is no lease transaction, so there are no lease transaction entered into, if there are no lease transaction entered into by the entity, so AS 19 effectively is not applicable. Yes. No, better to disclose that AS19 is to, because it is a level 1 entity. Accounting standard is applicable. As a part of disclosure, you have to mention AS19. At the end, you can mention that the particular entity, no, the entity has not entered any such transactions during the year. We have to mention, yes, 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 yes. That is where, sir, in the way of pointer, a draft significant accounting policy, we can draft it and keep it as a SOP document or so. Then based on the level of entity, we can modify that. No, no, we can just give highlights. That is okay. No, no, that is fine. Actually, it is a lease agreement, non-rent agreement. If you say 11 months time, it may fall under the rent this thing. So we have I think Rent Control Act. I just don't recollect the definition of that word, rent, what is here, but actually that is a lease. So if you see, sir, the online agreements nowadays which has been entered, it mentions leave and license agreement. It never mentions rent agreement. It is actually a leave and lease transaction. Because, sir, in operating lease, if you see the definition of operating lease, it says that what is regarded as an operating lease, where ownership is not getting transferred, one of the criteria. So it falls under the criteria. It is a lease transaction, not a rent transaction. Yes. Sorry, sorry. Yes. Yeah, so this particular aspect is to be read together, 250 and 50. 50 crores is any point of time. If it crosses during the year and at year end, if it is below 50, it is getting covered as level 1 entity. Satisfied, yes. Yes, yes. It is not or, it is and. Because if we see, sir, the purpose, if they mention it as or, many entities will get covered under level 1 entity. So the purpose is that it is not, I understand it is not easy to follow all the accounting standards, specifically for non-corporate entities. As I said, it is not unregulated, but it is bit of unorganized sector. So it is and. Yes, sir. Account it everything on going concern basis. हाँ, मतलब फाइनेंशियल स्टेटमेंट जो आप बनाओगे दैट विल बी ऑन नॉन गोइंग कंसर्न बेसिस. That is, मतलब you will disclose that particular aspect also, make a disclosure that the intention of the promoters or partners or a proprietor is to close down the business. It is there in AS1 that the going concern is effected when the intention of the owners is to liquidate or close the business. Yes, yes, simultaneously. It is not individual condition. You are out of that. Yes, that is what sir also mentioned, that if I fulfill the borrowing criteria, but I don't fulfill the turnover criteria, I don't get covered under level 1. It mentions and, so both. So any other point, if we have to discuss, we can. that itself will be the first non-compliance. Yes. Sorry. If it is a corporate, yes. If it is a non-corporate, we tend not to give any audit report because unless until see, if it is a non-corporate, we just give audit report in the form of 3C, 3CB, 3CD. That itself is an audit report, but we don't disclose that he has not done actual valuation. So it effectively becomes non-compliance to AS. You can, if you want to report, you can report that particular aspect in 3CB specifically in other disclosures. We can mention in notes. But that has to be done vigilantly because the consequences of that needs to be taken care and informed to the client. But if it is not done, inform, but better to disclose it. Yes, for not for yes, not yes. Sir, because if you are a part of or your firm is part of peer review, so that particular aspect gets highlighted over there. So better to disclose. So that is why I took the session in a way that what is the compliance which we need to follow, and then we come to non-compliance. Yes. Thank you.